Today we are going to focus on loans covenants. All right, that will be the focus of our discussion this evening. Maybe before we start discussing the loan covenants, first I need to remind you that there are three basic principles or canons of lending. All right, there are three basic principles or canons of lending. These canons of lending or these principles are supposed to be adhered to by all bankers or all credit officers, okay, because they are of paramount importance to a bank. The first canon is known as safety of the fund. The second canon is liquidity, and the last canon is profitability. All right. Safety of the fund, that is, you as a banker supposed to ensure that during the entire tenure of the loan, that is to say, during the entire time when bank funds is in the hands of the borrower, is supposed to be safe. So you need to use all means at your disposal to ensure that the fund will be safe all the time until the entire loan is repaid back. Liquidity. Remember, we are loaning out depositors' funds, and at any given time, a depositor might come to the bank asking to make a withdrawal. That being the reason, you have to ensure that repayment is timely so that the bank will be as liquid to meet depositors' request for withdrawal. As a banker, you have a responsibility to ensure that you protect your bank from suffering or from getting into liquidity crisis. Last, profitability. A bank incurs a lot of costs in order to run the banking business or to run different operations. These expenses are somewhat supposed to be covered, and one area from which we can get funds to cover these expenses is from lending business. That is to say, now we need to charge appropriate interest rate so that lending will be profitable. We generate profit sufficient enough to meet other banking costs. But let me take you back to safety. When we say safety, how do we ensure that the loan or our money will always be safe? Will always be safe in the hand of the borrower? First, what we do is that we ask for security. The security can serve as a collateral for the loan. It's a backup plan. That is to say, in case we suffer a loss, in case the loan is not repaid back, or just in case the borrower has defaulted from their contractual obligation, we can recover our funds following sale of the security. However, this is costly, so we do not really need to depend on security. But second, to ensure security, to prevent moral hazard, we need to monitor. Therefore, monitoring is also an important aspect of the loan, of the lending business. But now, what is it that we're supposed to be monitoring? What are we supposed to be monitoring? We monitor the uses or usage of the borrowed fund. We monitor the project that has been financed by the bank. Now, monitoring can be on-site and as well as off-site. So sometimes you will be required to physically visit business premises of the borrower. But sometimes you may request the borrower to send you some reports. Okay, and you can go through the reports to ensure that everything is going as per the agreement. Now, speaking of the agreement, what kind of agreement are we talking about here? The agreements are the covenants, or call them loans covenants. Now, covenants are also known as the terms and conditions of the loans. Okay, terms and conditions of the loans. Banks have the duty to ensure that money lent is repaid as agreed, and this duty can be carried out through monitoring and control. When accepting the credit terms and conditions, the borrower, in essence, is entering into a credit agreement. All right? The borrower is entering into a credit agreement with the bank. Now, the credit agreement is the one that will oversee the entire relationship between a banker and this individual borrower, or and this borrower, to the end of the loan contract. I'll say again, the loan agreement is the one which will oversee the safe voyage between the borrower and the lender. Now, the terms and conditions which the borrower needs to accept are known as the covenants or loans covenants. Now, in simpler terms, by signing the terms and conditions, the borrower agrees or promises to do the following. Number one, to take some certain actions. Number two, to meet some certain financial tests. 3, to refrain from certain behaviors while the loan is not fully repaid. Now, to take some certain actions. Every single borrower have their own funding need. And the funding need might be due some specific circumstances. Other businesses will come to ask for a loan for a rescue. And if the bank has evaluated the application and come to a conclusion that yes, indeed this business can be saved, yes, bank will agree to refinance that particular business. However, there will be some conditions or terms that business needs to meet during the entirety of the loan. For example, don't buy new assets, or don't dispose current assets or available assets. And what about financial tests? Financial tests can be, for example, at the end of the year, your business needs to reach profit margin of, let's say, 50% or 60%. Another test can be, for example, liquidity ratio needs to be or needs not to be below 2 or below 3.5. So the credit officer or the lending officer is the one who will propose some specific covenants for the borrower to follow, because the credit officer is the one who have thoroughly gone through the entire business and appraised the entire credit proposition. However, covenants are just on papers. Therefore, if you do not do monitoring, if you do not monitor the covenants, then they will never be efficient. That is to say now, the moment a loan officer, the moment a loan or credit officer disburses funds, the moment funds are disbursed to the borrower, and the borrower agrees to some terms and conditions, then for the terms and conditions to work out fine, the loan officer needs to switch from being a banker and become a policeman or a policewoman. If you do not monitor terms and conditions, then covenants will never be effective because they cannot monitor by themselves. Now, the types of the covenants that we should impose to any business or any borrower will depend with the degree of riskiness that is involved. The degree of riskiness can give you an insight of what covenants you should impose to your customer. Now, why do we need the covenants? Covenants help to define duties and obligations of the borrower relating to business operations. Covenants as well give the lender to manage its fund in the hand of the borrower. One thing I should tell you is that during the entire time money is in the bank, then say this fund is almost 100% safe. But the moment money or fund is not in the hand of the bank, then it is not 100% safe. Therefore, we need to find a way to ensure that these funds will continue to be safe. Again, covenants can assist to define duties and obligations of the borrower. That you as a banker, what do you need this business or this project or the management of the business that you are financing to fulfill in a specified period of time? Can be on quarterly basis, can be on semi-annual basis, or on annual basis. What do you want this business? What kind of performance are you looking for this business to achieve? Again, covenants can assist to avoid conflicts between shareholders and the lenders. Why? Shareholders simply means business owners. Shareholders simply means business owners. Business owners have their own goals. They have their own goals. Lenders as well have their own goals or objectives that they want to achieve. And it's not really true that all the time these goals are the same. In most cases, they are not. But we need one of them to agree to the terms and conditions that have been imposed or are imposed by the other. And in this context, since the shareholders or owner of the businesses are the one who have come to the lender asking for the money, then the lender has the right to impose his rule over the shareholders. Now, I understand that not all shareholders are managing their business. Okay, they have entrusted their business to the agents. Agents can be managers. But again, to remove pressure that shareholders might impose over the managers, covenants play a greater role in this. That is to say, if shareholders are pushing the management to undertake some actions that may contradict terms and conditions of the loan, then the managers can use or can show these covenants to the shareholders, and by doing so, then the conflict of interest will be avoided. Last, covenants are there to ensure repayment of the credit facility. Now, there are two types of covenants: affirmative covenants and negative covenants. What are the affirmative covenants? Affirmative covenants simply means all those guidelines that the borrower is supposed to adhere to in the operations of the business. All those covenants that the business owner or the management is supposed to follow in the operations of the business, in the day-to-day operations of the business. So the bank will want the business to behave in a specific way during the entire tenure of the loan. The moment the loan has been fully repaid, then the business can revert back to its old ways of doing things. And then we have negative covenants. Negative covenants require the borrower to refrain. Very important to understand this, all right? These ones require the borrower to refrain into taking certain actions. Okay? The borrower needs to do their best to ensure that all those actions which they would have taken in absence of the loan are not taken. So they have to refrain from taking certain actions that might have taken in absence of the outstanding credit facility. That is to say, as long as you have bank's money that is during the entire tenure of the loan, don't do this and this and this. So these are don'ts. Right? These are don'ts. Now, debt covenants vary from one institution to another depending on several factors. All right? Debt covenants vary from one institution to another depending on several factors. First one is objectives of the lender. Okay. Most likely, when two banks might be financing exactly the same project, all right? Let's assume that we have two banks, banks XYZ and banks ABC. Both banks are financing agriculture. All right, both banks are financing agriculture. Now, agriculture, this is the same product, but the question is, do both banks intend to achieve exactly the same goal? Probably no. Now, if this is the case, then even the types of covenants that these two banks will impose to the borrower over the same line of financing will be completely different. Not necessarily the same. Again, nature of the market. Who are your customers? Who are your borrowers? what are their financial condition or status, the level of competition. Remember, you are not alone out there issuing these credit facilities. There are too many banks. Now, if there are a lot of banks issuing almost similar products, the competition is stiff, and you want to win customer. So you need to be careful on what type of covenants you should impose to your customer in order not to lose them. Because if the covenants will be too harsh or too difficult for them to follow, again, it might be a challenging environment for your product to prosper through the market. Source of the funds. Sometimes a bank can use excess reserve to issue loans. A bank can simply use normal depositors' funds. And also a bank can use borrowed funds. By saying borrowed funds, I mean any other source of funds besides depositors' fund, because even depositors' fund is simply a borrowed fund in banking perspective. Therefore, source of fund can as well lead the bank to decide on what type of the covenants to impose over this particular borrower. Types of facility. Okay. Terms and condition that we impose to customer when, for instance, they take overdraft is different from what we offer to customers when they take, let's say, a personal loan or business loan. Again, remember, business loan can be medium term, long term, or short term. So can be same product, business loan, but again, due to the time of maturity, again, the nature of covenants will differ. Now, generally, there are some issues that will appear with the covenants, okay, that are general to almost every kind of credit facility. So we'll have some covenants related to amount of credit, terms of credit, interest rate to be charged, commitment fee, service charge, restriction on the use of funds. Now, as regarding to the type and amount of the credit, this stipulates the kind of facility granted and the upper limit of the credit facility the bank has authorized to be used by the borrower. Okay, so this covenant will talk about the kind of facility that the banker has granted to the borrower, maximum amount, upper limit, the maximum amount of the credit facility that the bank has authorized to be used by the borrower. That is to say, you cannot use more than what has been authorized. So the borrower is not allowed to go above the limit sanction unless otherwise prior approval has been obtained from the sanctioning authority. We all know, for instance, in the case of the overdraft, okay, with the overdraft, the borrower will enter into a pre-arrangement agreement to overspend their bank account. Once this agreement has been signed, then the amount to be overspent will be named. Let's assume 10,000 USD. Now, if this is the agreement, then unless there will be any other arrangement, otherwise the borrower is not allowed to exceed this 10,000. Purpose of the credit. This covenant stipulates that the credit received shall be used for the purpose applied for only. That is to say, if you have asked bank to give you a loan. For what? Let's say to purchase a plot, a piece of land. Then you cannot use this money to purchase a motor vehicle, a car, even though both piece of land and motor vehicle are personal property. Okay, what if a business have just come to you asking of a loan, let's say to replenish goods in the business? The management of the business have asked for 50,000 USD to buy some specific goods. Okay, because these goods right now or currently have higher demand. The bank has appraised and come to conclusion that yes, the request must be granted simply because such goods have higher demand, the business is profitable, and so the loan will be repaid back. Now, the question is, what if this business or the business owner decides to spend only 40,000 to buy goods and another 10,000 to buy, let's say, a lorry or any other motor vehicle that will be used to supply these goods? What if, because now this lorry or this motor vehicle is not for personal use, no, it's supposed to be used by the business to facilitate supplying of the goods. Is this acceptable? No, this is not acceptable. Why not acceptable? Because the purpose of the loan was to purchase goods. So the appraisal that was done by a banker, okay, the appraisal that was done by a banker 100% focus on only purchases of the goods and not financing supplying of goods. So technically, this is what we call moral hazard. And if you do so, then the banker has a right to recall the entire loan on demand, or the banker has a right to take any action as against you. So diversion of fund is not acceptable. Terms of the credit. This covenant stipulates that the tenure of the credit facility will be blah 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 blah. For instance, 3 years, 2 years, 1 year, it depends with your agreement. Interest rate. This one will clearly state the interest rate that the banker will charge to that particular credit facility. So don't be surprised when you come across in the scenario that, for instance, personal loan charged 20%, or let's say 50%, business loan 20%, etc., etc. Okay, because there are a lot of considerations before the bank can decide the amount of interest rate to charge of a certain loan. Of course, for these bigger loans, sometimes a credit officer will sit down with the customer and discuss. Once they reach into an agreement, then that interest rate will be applied. So again, don't be surprised to say that you have taken exactly the same credit facility from the same bank, and maybe even maturity of the loan is the same, but your friend has been charged relatively lower interest than yours. Could be the power of negotiation, but also strategic objective of the bank. Probably the banker is looking to achieve something with this customer rather than you. Collateral simply means security This is an asset that the borrower will have to charge to the bank to serve as security for the loan. In case of default, then the unrepaid fund will be redeemed or recovered from the sale of the security. Now, with the collateral, you as a banker supposed to ensure that documents of title are submitted to the bank, they are well perfected and kept by the bank during the entire tenure of the loan. If it is an asset that can be insured, then you have to ensure that the borrower pays premium, sufficient premium for insurance of the said asset. The moment the loan is fully repaid, you have to give back the document of title to the borrower. Supervision and examination. The bank had the right to arrange and the borrower had the right to comply with any request for information, clarification, and examination of the business. Remember, I say that covenants cannot police by themselves. Someone needs to be out there to ensure that the covenants are being adhered to. Therefore, during monitoring, you as a banker might ask for some specific information about performance of the business. You might ask some specific reports to be submitted by the business to your bank. And in case that you need clarification, then the borrower needs to be in a position, needs to supply you with all information or clarification that you are asking. So during monitoring, these information are of paramount importance. And again, the information that you collect can assist you as well to make evaluation. Declaration, that is, the borrower has to declare the following. He will provide in a truthful manner all information required by the bank and faithfully comply with the requirement of the bank's lending policy, short of which some actions will be taken as against him or her or the business. So once he agreed to this, then he has to sign it. If the credit is not paid as agreed, or in an event of default, the bank will have the following rights. Number one, to set off against funds in any account held by the borrower in the bank. Let me give you an example. We have partners, okay? We have partners. This is Salome and Salema. Their partnership business is called Sa and Sa. Okay, Salome and Salema partnership business. Now, remember, when they come to open a bank account, okay, when they come to open a joint bank account, we inform them that they will have joint and several liabilities. I'm sure you guys remember this. Again, when they come to ask for a loan, okay, when they come to ask for a business loan, again, we inform that they have joint and several liabilities. And both of them agreed to this. That means they both signed. Now, what does this mean? Or what do we mean when we say set off? Let's assume the loan was for 75,000 USD. This is the loan that this partnership business requested and our bank agreed. The loan will run for 1 year. and it will have to be repaid on a monthly basis. Now, first month repayment was done, second month done, third month done, eighth month done, but in the ninth month the business defaulted. Now, after defaulting, the credit officer tried all means possible for the loan, for the outstanding balance to be repaid, to no avail. Now, that being the case, then the banker has resorted into recovery. The banker has resorted into recovery. Now, when the banker has entered into this phase, they come to realize that Salome has a personal account which has some funds. Let's say there is 20,000 USD in this bank account. Again, Salema as well has a personal account in the same bank, and this account had only 3,000 USD. And by the time these two defaulted, the outstanding balance was, let's say, 23,000 USD. So the banker can exercise its right of set-off. That is, the banker can take money from Salome account and Salema account, and this money will be used to repay the debt. But what if Salema's account had nothing and Salome account had 25 or 28 USD? If Salome's account has 28 USD while Salema account has nothing, the bank can deduct the 23,000 USD from Salome's account. And in case Salome complains that the money in her bank account has been used to repay the loan, then you will have to remind her that you signed or you agreed to joint and several liabilities. So the right to set off allow the bank to set accounts which are in the same nature in order to determine net debit or credit balance. But you cannot set off against what? Trustee account, an account that is held under trust. Again, by signing the declaration, the borrower authorized the bank to sell any and all collaterals in connection with the loan contract, or publicly for and in the name of the bank or on its own initiative. However, bank customers, I don't understand them. They will sign, they'll agree to this, but when it comes to the selling of their assets, what do? They run to the court. So you need to be extra careful with this. Again, by signing the declaration, the borrower authorized the bank to use appropriate authorities to enforce repayments of the debt or to enforce banker's right. So if the banker has decided to take you to the court or to any civil authority in order to enforce the repayment of the debt, please do not complain. There can be some other stipulations such as which goes like, for instance, the general condition for the credit agreement at the bank which have already been agreed to by the borrower also apply and bind the borrower even though not attached to the loan agreement in question. What about in case of dispute resolution and applicable law? In any dispute arising out of or in connection with the credit agreement, shall failing amicable settlement be referred to arbitration under the provision of Cap 15 of the laws of Tanzania, and the arbitrage award shall be final and binding on the parties. Of course, this applies only to credit that are issued in Tanzania. All right. So that is to say, every country will have their own provisions. So in case of any dispute, there will be some clear guidelines on where the dispute will be resolved. Now, let's skip to the affirmative covenants. Now, remember the definition of the affirmative covenant. It wants you to meet some standards, to do some things. For example, number 1, punctual payment of the principal, interest, and other fees or charges. Okay. Therefore, if you're supposed to be repaying your loan on every 24th of a month, then you have to do this. You don't want anyone to come and remind you over and over again. Please ensure that by this date, your account has sufficient balance, available balance, that will meet the repayment of the principal, interest, and any other fees if available. Punctual payments. Remember, punctual payments protect the bank from what? From liquidity crisis. Okay, because the banker has given you depositors' funds, and depositors might come at any time requesting a withdrawal. Number 2, furnish statements and other financial information when required. So the bank can enter into a pre-arrangement with you for your business to furnish financial statements or any other financial information, let's say on quarterly basis, on semi-annual basis, or on annual basis. It depends with the agreement. But also, it might be on call. That is, at any time, if the bank decided to call for this information, then you have to supply them to the bank. In case there is any litigation, okay, as against your business assets, you have to notify the bank. And also, if a banker has come to your business premises, they have to be allowed access into the business premises as well as to some records. Remember, banker, right after disbursing the funds, are supposed to perform monitoring. And as I said, monitoring can be on site and sometimes off site. On site monitoring, a banker physically is supposed to visit the project they are financing or the business that has been financed by the bank. Off-site can be through going some records that have been sent, etc., on timely basis. Therefore, in case the banker have decided to visit your business premises today, then they have to be allowed access into premises, but as well as any other information that they will want to inspect or to check. Now, some of the assets might be pledged to serve as collateral for the loan, but also some of the assets might have been part of the financing package of the bank. Now, if it is the responsibility of the borrower to ensure that these assets are insured, then this covenant requires borrower to ensure that all premiums are paid up to date. Premiums need to be paid up to date. Now, let's see the negative covenants. Again, remember the definition. What are the negative covenants all about? They are about restriction, to refrain from doing some issues. Now, what are these? Number one, the covenant might impose debt limitation. Remember, we have like those debt ratio. So the debt ratio might be, for example, with this covenant might be like this. During the entire tenure of the loan, debt ratio should never exceed 25%. That is to say, this business is restricted from taking multiple loans, because if you take multiple loans, then the debt ratio will increase. So you have to finish this loan before you could go and take another loan. That's debt limitation. Number two, limitation on fixed assets. Limitation on fixed assets. Like I said before, sometimes we finance businesses that were on the verge of collapsing. So we give them rescuing packages. Now, with the rescue package, a banker needs to impose negative covenants to ensure that the business won't be involved in some actions or acts that will jeopardize the usage of the borrowed funds. For example, don't purchase some more fixed assets. We all know that fixed assets are not as liquid as current assets. And sometimes fixed assets will end up withdrawing funds from the circulation, from the business cycle. There should be a limit of fixed assets that the business can have. Therefore, don't buy, for example, new cars or even used cars. Not acceptable. Maybe don't build new houses or new buildings, etc., etc. Again, the covenants can restrict the business to consolidate, to merge with another business, or even to sell any other assets. So that is to say, if it is necessary for the business to sell, let's say, some old motor vehicles, then the business needs to seek permission from the bank. There is the question of change in management. Why do you think this one is important? Particularly when we are rescuing a business. Remember, during credit appraisal, we may decide to use Campari or 5Cs, but what I want to talk about is A, which stands for ability. Okay, ability of who? Ability of the management. Okay, the bank has issued this credit facility simply because, beside other factors, the bank has a full trust on the management team. Therefore, you are not authorized, or you are not allowed to change the management. Why? Because we gave you this loan based on the management that we have apprised, and not the new management. It is the management that has tendered the loan application that the bank has full faith, and not otherwise. So don't be surprised if the bank restricts you from firing some of your management team, members from your management team. Again, the negative covenants can restrict the business from offering dividend. Remember, dividend is offered at the end of financial year following a profit that has been made. So, if the bank wants to rescue this business, or the bank wants this business to grow, profit can be a very useful tool for the business to grow. Retained earnings is an excellent tool to refinance or to finance business projects. Therefore, the banker can restrict your business from giving out or issuing dividends. Now, let's see the credit or loan agreement. If the customer's request is approved, the credit officer will check on the property or other assets to be pledged as collateral to ensure the lender has immediate access to the collateral or can acquire title to the property involved if the credit agreement is defaulted. This is known as security perfection, or perfection of the collateral. It's very, very important to ensure that you as a banker has a right of claim, legal right of claim over the asset that the borrower has pledged to serve as collateral or security for the loan. If you do not perfect security, you might end up in a problem, particularly the customer has default and you want to realize the borrowed fund following the sale of the pledged security. The lender draws a credit agreement which stipulates the amount given and terms and conditions against which the credit has been granted. Remember, terms and conditions are the covenants. Okay, so if the credit facility is for, let's say, 75,000 USD, then on the credit agreement it has to be shown. And again, all terms and conditions needs to be mentioned. That is the reason when you inspect a loan application form, at the back pages, you will find their terms and conditions written there. And again, you need to read them carefully before you could sign. The problem is, borrowers always sign documents, important documents, without reading. They will come to read those documents only and if only there is a problem. That is the main, or should be the main concern to you credit officers. So, as a banker, ensure that you undertake all precautions in order to perfect the security. If the loan is considered to be too risky, then ensure that you provide very strict covenants. I'm not saying that if the business or if the credit facility is considered less risky, then you shouldn't use covenants at all. No. Use your wisdom. Remember, I told you lending is an art. Lending is not the law of physics. These borrowers can change their color at any given time. Now, once the credit or loan agreement has been prepared, all parties must sign, signifying that they agree to the terms and conditions of the loan. They agree to the covenants. That's the reason you see in the loan application form, you ask your customer to take it to a notary, public notary, or sometimes to an advocate, wherever. But also you want the customer to sign themselves, depending with the type of credit facility. And afterwards, the banker will as well sign the loan forms. Now, as a banker, you have to ensure the following. Number one, the borrower accepts and signs the agreement unconditionally. Do not force. If they do not want to adhere to all those terms and conditions, simply decline disbursing the funds. So again here, I should remind you bankers. Earlier I said, borrowers do not read these terms and conditions. They will come to read them only after they've suffered or they've entered into some argument with the bank or the banker. Conversely, bankers do not take your time to discuss with your customers the meanings of those terms and conditions. You bankers don't do so. You simply, sometimes, you show the customer, you point out, like, I need you to sign on this page, sign in here, sign here, sign here. Sometimes you circle, like, sign here, sign here. And when you reach page number 12, then I need you to sign on every page from page number 12 through page 20. You provide the customer with a pen and you ask them to sit somewhere and start signing. And also, since the customer is excited, they want to get the money as quick as possible, they don't take their time to go through the terms and conditions. They simply sign, sign, and sign, and sign. Now, in case there is an issue of default, is where you will hear the customer saying, I didn't know this. The bank will go like, you sign here. Then the customer argue, but we never discussed this. And again, I should inform you, that is a contract. And a contract needs to be written in the language that is fully comprehensible to both parties, and particularly the borrower. So some of the contracts that we give to our borrowers are written in the language which is not 100% understandable to the borrower. That is wrong. Don't force the borrower to sign. Ensure the contract is fully comprehensible to the borrower. The borrower must fulfill all the conditions precedent before funds can be released. If the borrower is supposed to furnish the bank with some specific documents, for instance, the document of title or some financial statements, etc., then you as a banker ensure that funds will be disbursed only after you are fully satisfied that the borrower has fully submit all required documents, not otherwise. The moment you give funds, they disappear. So it will be difficult for you to recover those documents if you disburse funds before you collect the required documents. Once you do so, then you can rest assured that at least phase 1 of lending has been fulfilled, and so you can continue with monitoring and afterwards evaluation.